Welcome, everyone, to tonight's Sunday macro wrap up. My name is Johnny Zerdy, and today we have a pretty good session for you guys today. The title of this video is Fade the Noise because there's a lot of news out there. And yeah, I mean, I've just seen on social media how, they're talking about the Russia Ukraine situation. They're talking about, Powell resigning, all these different supposedly catalysts, but none of that stuff really matters. All that does matter is the trend of the current setup right now. And so, as long as you pay attention to that, you're going to be fine. A lot of the news that's out there, you can pretty much fade. For those who are joining live for the first time, welcome. The way that these Sunday macro wrap ups work is that the first half, the first 30 minutes, is streamed online. And then the second half, the last 30 to 45 minutes, is actually offline for just our members. And so I have our Zoom being recorded right now. And so if you guys want access to the remainder of the meeting, which we're going to be talking about actionable ideas, you can go ahead and start your 7-day free trial of our macro investing community, which you can find using the link in our bio there. But it's 7 days for free, and we have an entire course that's in there to sharpen your pencil on macro topics and how to actually apply it to the markets. As well as you get some actionable ideas from me, and you get trading ranges every single day, all that good stuff. But let's go ahead and get right into it here. And so, really, the three main things that I'm looking at, one is the dollar, right? So the dollar remains in bearish trend, and you have to look for different correlations that are either positively or negatively correlated to the dollar. And the main correlations that I'm looking at right now, when you look at the dollar, is you have the highest correlation being the S&P 500, and almost the exact opposite correlation would be gold and silver, as well as copper. But copper doesn't have as good of a trend as gold and silver. As well as you have a negative correlation with short duration bonds. So it's pretty interesting how you both have the S&P 500 and gold both in bullish trend, but they have opposite correlations to the dollar. And so that's why I am really hyper focused on what the dollar is doing next. And so with the yield curve currently in a bear flattener, meaning that the 2-year yields are rising faster from the most local peak than the 10-year, you're getting a flattening in the yield curve. And so as rates rise, that's obviously a tightening effect, right? So that's typically a signal that the Fed is getting more hawkish. And so we've had a couple days of a revert to mean with Treasury bond yields. And so we'll continue to see how that plays out this week. But we've already seen pretty much that Scott Bessent, the new Treasury Secretary, is pretty much doing the same thing as Janet Yellen, meaning he is issuing bonds at the short end in order to essentially provide the market with liquidity. And it's very short-term looking. There's no really changes from what Janet Yellen was doing. And he was actually being critical of what Janet Yellen was doing, but yet he's doing the exact same thing. So a little bit funny there. But yeah, I mean, that's not something that is sustainable in the long run. So we'll see what happens from there. Clearly, the market is pricing in that injection of liquidity with the way that bond yields are reacting. And so we did get some lagging inflation numbers this week, which we'll go over in 1 second. But ultimately, there's a reason why, Bitcoin is acting the way that it's acting, because typically when Bitcoin does something like this, which is go vertical, that means that there's ample liquidity in the markets. And, typically that means that growth and inflation are having a rebound at the same time, or accelerating at the same time with ample liquidity. All right. So you had a pretty good dip buying opportunity in Bitcoin at the end of last week. So hopefully people were able to take advantage of that nice little dip there. But yeah, the S&P 500, interestingly, it is remaining in bullish trend. I believe futures just opened up a second ago, and it's slightly down, but nothing too crazy. But even if you take a look at this, I wouldn't be surprised if the S&P 500 had another retest, right? If we take a look at the SPY, maybe it comes down to 574 before it continues higher, but it's definitely lost some momentum. And so I wouldn't be surprised if it gives another add-in opportunity in the next week or two. Now it's not guaranteed. Obviously, there was a little bit of a buy opportunity on Friday of 2 weeks ago, so there was that. So we'll see what happens this week here. But ultimately, the S&P 500 is now in bullish trend. It went neutral in our model right around the beginning of May here, and then it went bullish on this move here. And so what that means in our model is that, yeah, the S&P is bullish. Somebody sent me a DM on Instagram, and he was like, "Weren't you bearish on the S&P 500 just a couple weeks ago?" And the answer is yes. I'm not trying to time bottoms. While the S&P 500 was doing this crazy, 20% down, 20% back up thing, there was a lot of other assets that were in bullish trend where you could have been making money around this same time, where essentially since late February, it's now back to where it was, right? So you could have had a heart attack and held throughout this entire thing, and now you're at break even, or you could have shifted allocation into other assets that you're paying attention to that remain in bullish trend while you're waiting for the S&P 500 to reclaim back bullish trend, and that's exactly what we were doing, and things like gold and others. And so taking a look at that, also seeing that, tech is back to bullish trend, the Mag 7 is back to bullish trend. Pretty much when you take a look at risk assets, right, here's the consumer discretionary to consumer staples ratio. You can see that this is also back to bullish trend. Interestingly, it's failing a little bit at the 2.62 ratio, which I have highlighted right here. This was a place of previous resistance back at the end of March before it headed down lower. And so what I really would like to see in order to gain a little bit more confidence with the current risk on trend is if this continues higher. Now that's what I'm really paying attention to, but it also remains in a bullish trend. So I will continue to monitor that with the team. Yeah, gold, even though it remains in bullish trend, like we mentioned, it really depends on what the dollar is going to do next. Typically, in this type of environment, because gold is a rate sensitive asset, typically it tends to lose strength when rates are accelerating like they are. And so if this continues, I wouldn't be surprised if gold either goes sideways or maybe goes a little bit down. In the meantime here, my team and I have reduced our position size on gold and have gone on to better things. So that's the way that you do it. Just make sure you own things that are performing the best. Simple enough, right? Taking a look at the VIX, this remains in bearish trend, which is bullish for the underlying asset. Same thing with bond volatility with the MOVE or MOVE index. Typically, the financial markets really like it or prefer when the MOVE index is in bearish trend. And yeah, we continue to see credit spreads remain coming down. That's bullish for financial markets. And yeah, I mean, with everything that I'm seeing, and we'll get into the macro data here in a second, the charts aren't saying anything different from what they were last week or the week before, despite a lot of the news headlines that you might be seeing. So let's go ahead and get into some of the macro data from last week here. So yeah, last week we had a decent amount of mixed data, and it was actually pretty clear. We saw continued stagnant growth or even slowing growth, and also we got pretty much the last print of inflation disinflating. So we got a lot of that. So taking a look at just some of the different metrics here, we're going to go through it in rapid fire. The University of Michigan Consumer Sentiment Index continued lower, but this is losing a lot of credibility because it's been found that it's widely biased. So, the University of Michigan Consumer Sentiment Index, it used to be a widely looked at metric where I think now it's a little bit less popular. So you got to take this one with a grain of salt here. You can pretty much look at this, typically for, consumers as well as small businesses. Not only that as well, but when you take a look at a chart of the Russell 2000, you can get a pretty decent outlook of, how small businesses and consumers are feeling. Because I mean, look at this. I mean, the Russell 2000 small cap stocks, it looks a lot different than the chart of SPY, right? So the Russell 2000, it's no longer in bearish trend. It is now in neutral, which is a positive rate of change. But still, smaller companies are having a lot worse time than a lot of the larger mega caps. Just going through some of the macro data here, manufacturing, new orders, capital goods, core capital goods, continued to come down. Consumer sentiment, the present situation versus expectations index did have a rebound, but still remains below that 80 mark. And this is from the conference board. This isn't University of Michigan. So there's still a little bit of hesitancy when it comes to consumer confidence. The Richmond Fed Manufacturing Index for, both manufacturing as well as services, both had below trend marking still, even though we had a little bit of a rebound in the Richmond Fed Manufacturing Index. Again, a leading economic indicator. We saw that the volume of new orders still remains in negative territory. Local business conditions continue to decelerate for the third month in a row, as well as capital expenditures. Number of employees still remains negative, and prices paid continues to remain high, right? So prices paid in March was 3.75. That was before tariffs. Now it's, in the fives. So that remains there. This is the Richmond Fed Services Index, which that has, fallen below zero. It's pretty much remained below zero, though, all the way from, I think it was around June or May of 2022 until it really took off above it in August of last year. And then it came back below it again. So these aren't, super set in stone. It's just, you have to look at these as well as the other Fed banks to determine, national trends. But that continued to show deterioration. The Fed's preferred inflation gauge, which is the core PCE price index, that continued downward to its lowest level really since 2021. And although, this is can be reported as good news as inflation is coming down, from what we're seeing with the rate of change of oil as well as other metrics, this could be remaining stickier than previously thought. When you take a look at something like the trimmed mean PCE inflation rate, which is essentially PCE prices, but it removes the more volatile components. So it's almost like a core PCE, except it's a little bit more nuanced. But this actually remained unchanged since March. So you're already seeing a little bit of, a flattening of inflation remaining higher a little bit from the past couple months. Real PCE, so consumer spending, continued actually higher for the second month in a row to its highest level, I think, since when was that? That was March of 2022, the last time it was this high. So pretty interesting acceleration in core PCE or real PCE rather. So we're seeing a rise in consumer spending. I don't know how much of that is actual consumer spending, but we're seeing that continue to accelerate. Total vehicle sales still remains elevated, largely in part due to people trying to buy cars before the tariffs increase prices. One of the leading economic indicators that we look at, which is the motor vehicle retail sales for heavyweight trucks, that continued to go lower, although it did have a little bit of a spike here these past couple months. That still remains in a downtrend. This is millions of units. So let's take a look at the percent change from a year ago. And yeah, so the year-over-year change still remains negative, which is a leading economic indicator there. And the United States Chicago PMI still came down to pretty low levels, levels that, haven't been this low since February of this year, largely due to the decrease in new orders as well as order backlogs and production. So, yeah, we're still seeing a lot in the manufacturing sector, a slowdown. Now, when it comes up to this week, we have a little bit more of a busier week. We have ISM manufacturing PMI coming out tomorrow. And then, just like every single month, at the beginning of the month, the first week is always jobs data. So we have JOLTS, which is job openings, layover, and turnover survey. The job openings numbers, that's on Tuesday morning. We have ADP employment on Wednesday, ISM services on Wednesday, Challenger job cuts on Thursday, and then we have the unemployment rate and the official non-farm payrolls or jobs number on Friday. So those are the catalysts heading into next week. Really, the jobs market has been something that has been pretty fragile. I mean, I'm sure you've talked to somebody or maybe yourself, where it's been pretty difficult trying to find a job out there. Even if you're someone who is highly qualified for a position, for some reason, a lot of businesses are like having postings as well as they're doing interviews for those postings with zero intention of actually hiring for those, which I don't know how that's legal or how companies are able to do that, but they're pretty much having job postings to satisfy a quota number, which again, I think that should be totally illegal. You're wasting people's times and money, frankly. So I'm not sure how that happens, but it is happening. So the jobs market is pretty fragile. If we do start to see a large acceleration in the unemployment rate, then that could be something that really not only spooks the market, but also brings bond yields down, as the Fed would have to be cutting rates into that. So we'll see what happens there. We got NVIDIA earnings. I can go over that in a second. This week, we only have Broadcom. That's the other, I think it's the 8th largest stock in the stock market right now. And that company reports on Thursday. So let's see. Yeah, we had NVIDIA earnings and it came out pretty solid, although when we take a look at the actual statement here, we can see that the Q1 numbers from 2025 this year, that 69.18% revenue growth, when you compare it to Q1 of last year, so Q1 of 2024, which had a 262% gain year over year, you can see that the 2-year stacked growth, so 262, is a lot bigger than 69%, even though, 69%, that's still a large number. And it's still a nominal number of 44 billion compared to 22 billion, right? That's, you doubled your revenue in a year. But still, it's not as high as a growth number, right? And so all that really matters is the rate of growth as well as guidance. And so you are seeing a little bit of a slowdown there. So we'll see how it recovers moving forward. And then I think that's pretty much all I have in terms of the updates here. But yeah, I mean, in terms of what I'm looking at in the markets, just to highlight again for those who are just joining, I'm really eyeing what the dollar is going to do this week, because if this does right here form a higher low and ends up accelerating farther, then that would be really good for the S&P 500. If it continues bearish trend and it breaks down further, then that would be a headwind for the dollar, just because we're seeing a positive correlation currently with that. So that is what I am seeing there. But for those who are joining, our members who are joining on the Zoom call here, hold on. We're going to be getting into our private messaging here just 1 second and go over some actual ideas. For those who are joining on the stream here, if you guys would like to join the rest of the conversation, like I mentioned at the beginning, you can join our macro investing community with a 7-day free trial using the link in my bio. For those who are on YouTube, it's in the description below. But we got to say goodbye for now, and we will catch you guys next week. Have a great rest of your Sunday, everyone. Bye.